There we go. All right, so as I mentioned, we had 3 questions that came in via email prior to the presentation. Luca wanted to know about what type of options can I use to do a bearish trade that reflects almost 100% of a stock decline. Lance emailed in shortly after that, and he says, why do I see in-the-money married puts on one of the power options tools, and should they be considered? And Todd sent us a question, Todd from Austin, sent us a question about using long calls around earnings with only 1 or 2 contracts for proper position sizing to potentially enter into a longer-term married put trade based on the outcome of the earnings event. All right, those are the broad overview of the 3 questions we're going to take on first. So let's get to Luca regarding the bearish trades. There are 3 main positions I might consider if you feel we're going into a bearish trend or you're researching a stock that you feel is going to have a strong bearish move. Number 1, of course, buy a put option with a high delta. As the stock goes down, the put increases. You want to start off with a higher delta, maybe 90, 93, maybe 85, somewhere in that range. So as the stock starts to go down, that put gets deeper in the money and the delta gets closer to 1. The synthetic short stock position. You can use options to mimic shorting the stock outright without the same obligations, though it does have a lot of obligations. And then, of course, there's a put ratio backspread. Now, there are others. There are also many other bearish plays, bear call credit spreads, bear put debits, calendar put spreads, covered puts, and more. But those are all capped bearish plays. They don't answer Luca's question about continuing to have near 100% value with the decline of the underlying security, okay? As well. So, Sam just commented in and said, Apple, J&J had nice moves to profit this week. Yeah, Ring Central and Avaya, they announced a merger and they really took off as well. I just mentioned that here because it's not related to our conversation, but we're going to use Apple as an example. So what we're looking at here is the option chain, truncated a little bit, but the option chain for October 18th expiration on Apple, which is currently trading at 226.92. This was at about 3:50 p.m. Eastern Time. It might have changed in the last 10 minutes or so while I was putting the slides together. So what, of course, we're going to look at here is I've selected to view the delta, and I've just truncated it to all the options that have a delta in that 0.90 range, closer to 1. The 240, 250. Right, the deeper in the money puts are going to have the deltas that are closer to 1, naturally, which also means they're going to be in the money. This is a 242.50 strike put, so we're roughly 16, 17 points in the, I'm sorry, it's not that high actually. Yeah, it's about 15, 16 points in the money. And you see the cost basis here at 15.65, 15.85 for contract. One contract would cost me $1,585. As we go further down to the higher deltas, we see the 250 strike here with a price of 23.25 and a delta of 0.97, almost at 1 already. What does that delta of 1 mean? Or in this case, negative 1, because we're in a put option. It means that for every dollar the stock gains, I'd expect to lose $1 on my option premium. But for every dollar the stock falls, I'm going to expect to gain $1 on my option premium. In this case, 97 cents, pretty close to $1. And as the stock continues to fall, if we're correct, this delta is going to get closer to 1, as we see the much deeper in the money puts at 270. But this again would be a cost, as you can see here, of about $2,300. It cost me $2,325 for 1 contract. But if the stock falls $1, that's going to be worth $24.25, pretty close to it. Drops another dollar to be $25.25. And of course, you got to hit a break-even point, don't you? And then you get further profits on at almost a 1-to-1 ratio. Okay? But what is something else we see here regarding this put option that's 14 days out in time, deep in the money, high premium because most of it is intrinsic, and a high delta? There's not a lot of volume or open interest, if any, on these deeper in the money strikes. That doesn't mean too much in this case with the shorter term option. It's only 20-cent bid-ask spread, but it may be harder to get out of the position if there's the sudden decline you're looking for. Implied volatility spikes in this case. The bid-ask spread might get wider, but there's not a lot of activity here. You're technically trading against the market maker. That's always a concern when you try to go these deep in the money calls or deep in the money puts to buy that have zero volume and perhaps even zero open interest as well. But that's the one play. Simple, easy. What's the risk? Cost of $23.25. If you're wrong over this 14-day time period, there's another recovery, perhaps, and the stock starts to move up to 230, 240, 245, or 250. You're looking at a full loss on the long call. It's going to go to zero. And this is a very short expiration. It's only 14 days. We'll talk about that in a moment. So that's option number one. Just buy a put with a high delta. Number two, the synthetic short stock position. Rather than selling 100 shares of Apple, which does give you the exact one-to-one you'd want if the stock starts to fall, you can mimic the profit and loss chart of short stock position using the synthetic short stock. You sell an at-the-money call, and you buy, that should be an at-the-money put. I apologize. This is what happens when you try to get your slides together in 15, 20 minutes before the webinar begins. But that's at the money. Same strike, same expiration. Here we're looking at the 227.5 call. Remember, our stock was at 226.96. That's the closest strike for the 18th October expiration as well. So how is this different than just buying a put? I am buying a put at the money, though. It has a much lower cost, but in this case, the delta is only at 0.5. Luca's original question was to mimic one-to-one, so that's when we were looking at just buying the option. We wanted to have that deep in the money. So I'm sorry, this is the 2275 put, but it has a delta of 0.5. But we're going to sell an at-the-money call, which has a positive delta of 0.5 as well, pretty close to it. In this case, since the call is out of the money, the put's slightly in the money, this is probably at 0.55, this is probably at 0.45, somewhere along those lines. So what happens when the stock starts to fall? Well, your put increases in value just as the in-the-money put you were looking at, and your call starts to decay. This one didn't give us the right price, but if you find the right prices on the right stock and the right strike price, you might be able to do this at a credit. This one, however, is done at a debit of about 38 cents. Not a big deal. It just moves the break even slightly. But, of course, if the stock falls, you're in a synthetic short stock position. But you're selling a call without owning stock. Without owning another call to hedge the position, the long put does not cover the obligation of the short call. So this is still a naked call, which is going to come with that monetary requirement of the naked call position. However your broker handles that. Plus, you may also need to be on level 4 trading to do this, because it is consistent of a naked call and the long call option. I'm sorry, the long put option. My apologies. But it does give you the graph that mimics a one-to-one gain using options, but your broker is going to require you to put up some margin for the position. It might even be the full monetary requirement of the short call position. It might not be, but it depends on your broker. But if it is, at that point, you're better off just shorting the stock. It's the same play. Less commissions, perhaps. Okay? So that's another thing to consider. Number 3, the put ratio backspread. Well, this one does give you a way to mimic the downturn of the stock, not quite at a one-to-one ratio. But you're also going to hedge it a little bit if you're wrong to the upside if you can get the right premium. So I might sell an in-the-money call to get a higher, in-the-money put, to get a higher premium. And let's say that I sell the October 230 in the money put. Not much, only about 4 points, but it's still in the money, and we get $6.90 for it. I'm going to tell you right now, I know there's 1 or 2 people who sometimes check me on this while we're doing the presentation. this isn't the price. I think the bid on this 230 put was around, the ask I think was around 540, and the bid was around 480 or something when I looked. Maybe it wasn't that high. But in any case, the reason why I showed this exaggerated price is when you do this, you typically want to get a credit if possible. That's the structure. So I'm selling a 230 put, but I'm buying two 225s. What does this give me? Well, it gives me a bull put credit spread is another way to look at it with a long put position. So the 225, 230, there's my bull put spread, and then I have the extra long put that continues to gain as the stock falls. 215 down to 210, down to 200. It keeps going this direction all the way to 0, just like the long put. You've got a bull put credit spread with a long put. Now, if you're wrong and the stock moves up, hey, you took a little credit that maybe covered the commissions. Of course, we want to talk about that too. That was a big change this week with many of the big brokerage firms. But in any case, you take it a 10-cent net credit to cover some costs. So if you're wrong and the stock moves up, you're not a large loss. What you do end up with is this wide death valley, is what one of our attendees refers to it as, the valley of death. And the valley of death is between here, the break even at about 230 and at about 220. Really, it's probably 219.90 and 230.10. I'm sorry, 229.90 would be the upper and lower break. Let's just call it 220 and 230. So if there's no event coming up other than an unexpected black swan event, there's no event coming up with the stock, where's the likely place the stock is going to end up trading with normal volatility? Right in here, in Death Valley. The stock's trading right at 225. These two puts expire worthless. It's going to cost you $5 to buy to close the 230 put or be assigned shares of stock at 230 for the naked put contract, or the short put contract, I should say. It's not naked in this case. So that's the risk there, whereas the other two positions, you almost started to see a profit right away, or if the stock fell 1, 2, or 3 points, in the case of the synthetic short position, you start to see profits right away. In this case, you need the stock to drop to 220 to start realizing that profit because of the difference in strike prices of the short put and the two long puts. All right, that 5-point drop there, that's the maximum risk, 490. The 5-point difference in these strike prices from 230 to 225 minus the 10-cent net credit that we keep as well. Okay, so that's another one. But again, with this particular example, I fabricated it just to show you the structure that you'd want, Luca. This spread would actually be here, where if it went up under your expectation, I think it was a loss around 230 or 240. But yes, you still had this maneuver down here if the stock continued to fall. So those are my 3 suggestions in that case. Sam adds that to do the short call, the naked call for number 2, the synthetic short, broker wants 100K as margin in some cases, or a 100K account. Okay, and that's would also put you up to level 4 in some brokers. So considerations here of which of these 3 to take: bearish positions using options that mimic a 100% of the stock decline. Well, it's going to depend on your profit goals, which best matches your targets for the decline and the effect if there were IV changes. Why is that important? Well, you're expecting a decline in a stock maybe over a short time horizon, whether from earnings or whether from fear of a market decline. So if it starts to decline, the implied volatility is going to shift. How would the shift in implied volatility affect the synthetic short position and the put ratio backspread and the long put as well? Time frame. This is also an important consideration when comparing these potential 3 or other ones you might come across. What time frame do you expect the decline to occur? Do you expect a 5% decline in 10 days, a 10% decline in 25 days, a 15% decline in 35 days? That helps you choose which expiration and then see which strike prices are available for that expiration and would still meet your needs, with the other 2 considerations in mind. And then the risk factors. What's the risk factor of the long put? You can have a 100% loss if you're wrong. In our October 18th example, only 14 days away, if Apple decided to start going up to 230, 235, we were looking at the 250. But if it continues up to 250, you're going to start to see that premium, that $23 that you paid, decay rapidly. And if there's a sudden move, wouldn't expect a 50, 60 point move in Apple at this point, but if there is that sudden move, you could quickly see an 80, 90% loss on that long put. So you have to be concerned about over trading. That gets us to one of our questions coming up next, the third question. 100% loss if it's wrong on the long put is a potential outcome. The vast margin requirement and risks we talked about with the synthetic short position is also a consideration, the risk factor. And then the dead zone of the ratio put spread. If there's no event coming up and you're wrong, the likelihood of the stock trading within that 220 to 230 range in normal market conditions for the next 14 days is extremely high, and you're in that death valley. You're in that dead zone V where it's hard to manage the position that you have, and you may take the full loss in the bull put spread and lose the time value that you paid into that extra long put to complete the ratio spread. But there you go. Those are my thoughts on the 3 ways to potentially play using options, a bearish play that mimics 100% decline in the stock. Buying that deep in the money, high delta long put, the synthetic short stock position, and of course, for a little bit more security if you're wrong and it goes up, not taking a loss. If you're wrong on it, trying to set up that put ratio backspread with a credit does have the problem of the dead zone if you don't see the move that you want, the death valley.